Hey guys, David Robinson here. Welcome to the apartment investing journey. Another week and another great guest. I'm excited to have Steve Breton with us. Steve, welcome to the show.
Thanks, David. Pleasure to be here.
Yeah, my pleasure. So, Steve is the founder of Velocity Capital, private equity real estate investment firm. Steve has been a regular on many podcasts throughout the industry, always giving back, always sharing his experience. He currently controls 1,300 apartment units valued at over 150 million. And what I'm excited to get into today is how he achieved an early retirement from his IT career. And Steve's often out there speaking at real estate investment conferences and also currently coaches both active and passive multifamily investors. So Steve's got a ton of experience and knowledge to share with us. And I'm excited to get into his story. And Steve, our podcast is all about the journey. And so we want to back up and sort of take us on this path that you've been on over the last, handful of years and the experience you had from when you first started getting into real estate. And then let's take it forward from there.
Sure thing. It's really exciting to actually be sharing that journey. I was listening to podcasts when I first started. It was right when Bigger Pockets first came out. Of course, that's sort of the go-to for people when they first start. And just listening to stories that, everything from fix and flip to, the BRRRR method or buying, renovating and renting, people doing notes and other, hard money lending. And I was like, my head was going to explode with all these different options. But that was at a time when I had a full-time job working in Boston with an hour and 20-minute commute each way, and I was working probably 60 hours a week. It was just crazy. And I was we were acquired, and I had to lay off some people, and just didn't love corporate America at that time. Before that, everything was great. I loved my job, and it was all wonderful. But it literally turned on a dime, and I started thinking about, okay, how am I going to retire? When is that going to happen? Is it going to be a good retirement, or are we going to be scraping pennies? Even though I had a great job already and had already saved a ton. So I started looking at all these different options, chose to buy a duplex here locally. And actually, I should rewind a little. I looked at everything, studied like crazy, and then did nothing.
I love that you add that in there because that's what, everybody thinks, oh, you just study this for a bit and then you take immediate action. The reality is most of us, it takes a while to actually take that action. So,
right. Not only that, I had a lawyer friend who very well-intentioned, super great guy. We're still great friends. But his job is to keep his friends out of trouble. And he's like, but real estate's risky and you're taking on, you can get sued, and just went on and on. I'm like, all right, forget it. So, that was sort of the tipping point for me to just be like, okay, I'm not going to do anything. And then I just kept suffering at my job and, figured I'll just keep saving more. I went through a small spell of extreme frugality, yelling at the kids to turn the lights off, not vacationing, only going to like cheaper eats for we're eating out or whatever. And I was like, this is miserable. Who wants to live that way? So then I figured, I'm going to go the other direction. I'm going to make as much money as possible. And that's going to lead to, and we can get into this later, but, wonderful things when you're making a lot more money, you can give a lot more to charity, hopefully retire early. And now you're spending more time with charities and just giving back to community. So I knew that was the right way for me to go. So reinvigorated, a few years later, finally bought that duplex in my backyard. Cash flow was pretty decent. And after a few months, I'm like, okay, being a landlord's not bad. I've got good tenants. I did all the research on how to do that properly and vet your tenants and all. And it was cash flowing. So I bought another one. And then a triplex, and then another triplex. And then over the course of that, that was like 2-year period of buying, things started to get more expensive, and realized, well, I'm probably going to have to buy a really nasty looking place that needs serious work. And I'm handy, so I didn't mind putting in the extra work on the weekends. Ended up hiring a contractor to do most of it anyway. But that property turned out to be wonderful. Sold that 7-8 years later for a huge profit. But got into the weeds on, like, I did a couple of fix and flips after that, and just really enjoyed it all, except for it was taking way too much of my time.
Yeah, I was actually going to just to have a frame of reference here. Roughly, what time frame, what year did you buy that first duplex? Do you remember?
Yeah, the first purchase was 2012, early
Okay.
like January or something of 2012.
Yeah. So obviously that, that time frame was a great time to buy. And were you buying in Boston or a different
Outside of
market?
Boston, yeah,
Okay.
about half hour west.
Okay. Okay. Great. So so in 2012, you buy this first duplex. You realize, okay, this isn't as bad as my attorney buddy made it out to be.
Right.
I'm actually making a little bit of cash flow here. Wait, before I move forward on that, I do want to go back because I think this is an important concept. You went from this place of, let's call it hyper frugality, to then shift into mindset to, hey, productivity, production.
Yeah.
You made it sound like it was just an easy switch to flip, right? To go from being very frugal to, all right, I'm just going to go make a ton more money. What was that like? Like, what was the mindset and what were the steps that you took to say, hey, I'm, just from a very practical perspective, someone who's maybe trying to make that shift for themselves mentally right now, what did that look like for you? And what did you do?
Gosh, that's a great question. And it's a journey. It's definitely not a switch. High level, it's frugality or limited mindset, moving to a more of an abundance mindset. But I didn't, I don't think people really spoke that much about that abundance mindset. At least I didn't hear it much back in like 2013. That's more of a recent thing. But back then it was, I think I listened to something podcast, or maybe I was probably reading a lot at the time as well. And I read something about all the tax benefits and how, Congress is giving people tax breaks and, all to do real estate because they don't want to be having to build, what ends up being ghettos. That's what happens when the government gets involved in government housing. It's just not good. So they want us to do it for them, and they give us huge tax breaks for that. And that's at that. I think it was at that time, in like 2012, 2013, where I was like, the government really wants me to do this.
Mm-hmm.
And I'm kind of angry that all these other people are getting these massive tax breaks. And at the time I was thinking, it's rich people, all that sort of limited mindset again.
Sure.
And I was like, wait a second, I can get those same tax breaks just like anybody else. And the tax breaks aren't for rich people. It's for anybody who wants to do real estate. And so instead of being angry, I figured I would join them. And from that came like, I can make a lot of money doing this. And there's nothing wrong with that. And, and I started to grow a bit more in my thinking. It was only, a few years later when the whole abundance mindset came about, people started talking about that more. And I slowly kind of slid into that thinking, which was wonderful, very comfortable space to be. And, and for anybody who's listening, who's not fully familiar with that, at the highest level, it's like, you think about sunshine. You can think about money like sunshine. So if I want to go outside and get some sunshine, and I can just sit there and be like, yeah, bring it, just soak it in. And David, if you want to join me in that, it's like, great, come over here and stand next to me. Let's soak it in together. It doesn't matter if it's 2 of us or 1,000 of us or 1,000,000 of us. It's abundant. It's not going to end. You can share it. And as crazy as it seems, making money can be very similar. And the more you're giving to other people and inviting to other people, the more opportunities come up, especially in real estate, because it's all about the network and who and how you play, in the sandbox. So if you're thinking in an abundance mindset and you're always giving and you're a net giver, not a net taker, then people are going to continue to invite you to play.
Yeah. Love that.
It's kind of like if you play Monopoly and you cheat, or if you're a jerk, you're not going to get invited to play again.
Yeah.
But if you're playing it and you're really nice to people and you're having a good time and everyone likes playing with you, you'll be invited over and over and over. Next thing you know, you've done, dozens of deals.
Yeah. Love it. Well, thank you for taking some time to sort of break that down for us. I think that's helpful. So, okay. So you buy the first duplex, then you realize, all right, this isn't so bad. Buy another duplex, a triplex, you buy small multifamily. Your focus was small multifamily initially. Yeah. And then you even get into some fix and flips. So take us forward from there.
Yeah. So, about 2 years in, I think I've got 16 units locally, across whatever that is, 4 or 5 properties. I've got a few fix and flips done, but I'm, at this point, when you've got a small portfolio, you're managing that. I'm coaching my kids' hockey and soccer teams. I've got 3 young boys at that time. Just so much going on, and the work and the commute. I couldn't continue to buy, and even managing the fix and flips is a lot of work. So a friend of mine introduced me to syndication, and totally new at this. I'm like, well, what is that? It's 100% passive investment. You're trusting somebody else to do real estate and to provide you a return. And so I started looking into that, and come to find out, buying properties in Atlanta and Tampa and Dallas or Phoenix, Arizona is better because the cash flows are just so much higher. Better than where I am anyway, in Boston. So I'm like, okay, let me give this a whirl. So when I save up my next chunk of change, instead of putting it down on a house or trying to do a fix and flip or something, I threw it into one of these investments. And it was a referral from a friend. So I didn't do a lot of vetting. Turns out it worked out fine, but I don't recommend just putting money with somebody without doing any vetting at all. But they had an opportunity. I invested, and it started cash flowing immediately. And a couple of years later, we cashed out, and and the returns were north of 20% average annual. And I was like, wow, that's pretty amazing stuff. That's better than what I was doing with all my cash flowing properties. But I don't have to do anything other than find the right sponsor.
Right.
So in that 2-year period, I had done a few more, and they were all starting to cash out, or they were cash flowing really well. So I just kept doing that, and I ended up selling off my rentals.
Really?
Yeah. That took over 3-year period. I just slowly, every year I'd sell one or two, and I still have one. And it was my first one. I'm just holding on to it. I don't even know why.
Nostalgia.
Yeah. I'm like, maybe my kids will live in it, or, they'll rent it from me, whatever.
Yeah.
They're all, either in or heading off to college at this point. So, yeah. So I still have the one, but I sold everything else off. And I stopped funding my 401k at work and put it all into syndication.
So talk to us a little bit about that. What was the thought process around that? I mean, a lot of W-2 employees out there right now really think that's their only option, right? Yeah. And they think that's actually going to lead to financial freedom in the future. Give us your thoughts on it and why you chose to go the other route.
Yeah, no, I was a typical W-2 earner, and I was told put 15% in my 401k, and they'll match 3 or 4% or whatever it is. And that was fine. It grew with the stock market. I mean, for many years it didn't grow, but nowadays it's on fire because the government's printing money. But in any event, that money is locked up until you're 65 or 67 or whatever the age is for people that are in their 20s now. That's a really long time to wait for your money. And I realized, when I started to make money in real estate, I realized, well, if I amp this up, I can leave my job even earlier. So instead of thinking, will I ever retire, or what might retirement look like? Is it going to be tight? I was like, I can probably retire 15 years early. I can retire my late 40s and retire with a great amount of prosperity and abundance, and really enjoy life. And that was just crazy. It's mind blowing to when you actually realize that's a possibility, a real possibility for you individually. That I was like, well, why am I putting money into a vehicle where it's going to be locked up for the next 20 plus years? So when I put it into syndication, it's immediate cash flow. Yeah. So it's going to improve my lifestyle right now because it's more cash flow right now. So I can take better vacations now with my kids and eat at better restaurants and whatever I wanted to do, and give more to charity. And then at some point, I'm building up that cash flow to the point where it replaces my income. And I go full-time real estate, right? Even if it's just managing a few of my smaller properties, gives me the real estate designation, a real estate professional with the IRS. And now I can offset with my depreciation expenses from my passive investments. I can offset my income in real estate as well as my wife's actual income, which is earned income. So I was like, this is a crazy path. Again, years ago, I would have been upset that the government's creating these things for rich people, these crazy rules that nobody can, no regular people can do.
Right.
And I figured it out. I'm like, I can just play by the same rules, and jumped in, and that's what we're doing today. So, my wife is a consultant, makes a good income, and I'm a real estate professional. A lot of my passive investments, which I still do a lot of passive investing, they'll kick off, let's say you put a 50K into a deal, you'll get 40K in passive losses or depreciation in that same year. Yeah. So that's 40K that just immediately offsets your income.
Yeah. Love it.
Right. You do a couple of those deals a year, it starts to add up.
You touched on this process of, working full time while you were building up, your small multifamily portfolio, and then you started to transition into the syndications. When did you decide, hey, it's time for me to exit my W-2 and focus on real estate full time?
So in 2017 or so, I'm thinking to myself, okay, I've built up a nice chunk of cash flow here, monthly cash flow, and I'm still a fair amount away from from leaving the job. I haven't replaced my income completely, but I'm looking at it and realizing this whole like tax benefit thing and being a real estate professional. If I just manage a couple of properties, so it's one of the reasons why I kept one of my properties.
Yeah.
But I had two of them up until very recently. And when I started figuring out the tax rules, I'm like, okay, I don't have to replace my entire income because I'm going to be paying a lot less tax, as we file jointly. So just figuring out the tax breaks and all that, I realized, okay, I'm pretty darn close already, which again was another kind of mind-blowing experience. And that's when I thought to myself, well, what am I going to do when I retire? Am I going to play golf every day? Which, I don't love golfing. I can only hit the gym so much. I love riding my bike, but again, can't do that for, 10 hours a day. I can volunteer, but, I was like, what would I do with all this time? I want to be productive. And I realized I really like this concept of syndication, and why wouldn't I do this myself as a sponsor and help my friends and family and other people to do the same thing I did, right? To achieve either a better retirement or early retirement, whatever it is. So, so I went and got trained on that. Went to a few conferences, hired a coach, and learned how to underwrite and learn how to manage properties from a distance, and all those things that are required. And by middle of 2017, I launched my business, did a few deals over the next year and a half, and left my job early 2019.
Love it. Well, that's an inspiring story. And I know a lot of our listeners are in that space where, maybe they own some small multifamily. Maybe they're still working W-2 job. They're looking for a better path. And you've been on that journey over the last, roughly decade now, and have carved out a pretty cool path for yourself and your family, and have really served a lot of people along the way, helping them along that same journey. I'm interested in hearing, I do want to dive into, if we have time, I want to dive into a deal that you've done in the past. We'll cover that here in a second, but I'm curious on your thoughts, maybe just in general, on the syndication world, the syndication business today versus 2017, 2018, when you first started getting into this space. What does the environment look like, and how is it different than it was before?
Yeah, so it's funny looking back in 2017, when I was thinking about hiring the coach, I interviewed a bunch of them. And one of the questions was, where are we in the market right now? It seems like it's a little high, a little hot, kind of crazy to get in 2017. Maybe I shouldn't be spending the money on coaching. I'm trying to talk myself out of it.
Yeah.
Conversations, right? Like, why would I spend all this money on coaching? And they're, they all pretty much said the same thing. Like, yes, the market's hot and it might crash, or, things might go sideways. But if you're learning now, or you continue to learn through that crash, if it happens sooner rather than later, when the market starts to come back again, or even, when it's depressed during whatever the next crash might be, you're already ready to roll, right? You already know how to do this thing. And I was like, oh yeah, that makes sense. And that's kind of why I went into it. So yeah, we thought the market was hot back then, but the returns, the prices, everything was way lower than it is today. And the underwriting was much looser back then. I'd like to think that it wasn't the case for me, but even now it's like you have to underwrite very, very tightly because the prices are so high. So I saw a lot of other people's underwriting, even people that I had invested with in the past. Once I started to learn how to underwrite, I started to dig far deeper into their underwriting and noticed, the way that they were underwriting wasn't very conservative. There was a lot of aggressive assumptions there. And when the market's hot, that's fine, right? You're probably going to meet those assumptions because the market's just going crazy. But when it's not bananas, it may not go so well for you. So today, things are super tight. Prices are crazy high, but rents have also gone up a ton over the past year. So you've got a lot of places, especially in the Sun Belt where I'm investing in Southeast. You've got 8-10% rent increases year over year. And even during COVID, those properties all did pretty darn well. So, prices can go up, but if rents usually in a down market, the rents won't go down very much. The prices will go down. So that you're kind of setting that floor for the rents every year as they go up. You might have a little bit of concessions. You might have to give away a free month's rent or whatever to get people into your place, but overall they don't go down very much. So yeah, it's hot right now. It's tight. You have to be super careful. You should know your underwriting a little bit. And I teach people, even passive investors, like, just do a 1 hour phone call. Let's talk about like the major levers that syndicators will pull to try to make a deal look better than it really is. And if you can press on those things and ask the right questions, maybe it is a great deal, or maybe it's not, but you need to at least ask a few questions to understand it better.
Yeah. Love it. Great. Well, let's transition a little bit. And if it's okay with you, I'd like to dive into just a deal that you've done in the past, this 106 unit C-class deal in San Antonio, Texas. If you, let's see, how long ago was this? This was, you've gone full cycle on that deal, right?
Yeah. So
okay, perfect.
2017, we get that deal under contract.
Okay. Maybe talk to us if you remember. I know this is, we're making you go, 5 years or so back, but talk to us a little bit how you found the deal originally.
Right. So it's my first one ever as a sponsor.
Great.
So I remember every detail.
Perfect.
Very exciting.
Perfect.
So I reached out to a few people, through the network that I had established by going to conferences and all that sort of thing. Met a couple people that I really liked. And in those discussions, it was like, I love underwriting. I can do a lot of the due diligence. I've got a lot of friends with high net worth in the area here in Boston, right? I worked in biotech and IT, and I was, mid 40s. So most of my friends and family were, roughly in that age bracket that could invest with me. So, when I offered these things, a few people were like, well, that sounds great because I live in a part of the country where there's not a lot of money, and I didn't work in corporate America and biotech or whatever, and I could certainly use some help with all the other aspects. And I also managed rental properties, right? My own portfolio. So I was just telling him, like, here's everything I can bring to the table if you want to partner. What I can't do is compete with you in getting a deal in San Antonio because you grew up here, a few brokers personally, you're getting stuff off market that nobody else even sees. And that's really what I wanted access to. So anyway, lots of discussions. Finally, one of my friends comes and says, I've got a deal. I just did the underwriting. It looks amazing. Please underwrite it yourself. Let's see if we come up with the same thing. We did. We both thought it was amazing. A week later, I'm flying down there. We're doing due diligence. We're walking the property. It was 106 units. When we got to the property and started looking around, we realized they had combined some of the units. So they took two bedroom units, combined them to make 4-bedroom, 2-bath instead of a 2-bedroom, 1-bath.
Interesting.
Which is kind of crazy. Like, I don't know why anyone would ever do that. But they did it. And they did it to 24 units.
Oh, wow.
48 total were combined into 24, which, again, absolutely insane.
Yeah.
So we were like, okay, if we just patch, the hole between the units, then, and we just add the kitchen back. And literally they had just capped the utilities, right? The water.
It's all stubbed out there. It was just covered.
It was just sitting there. And I'm like, we're gutting these kitchens anyway. Like, this place needed a lot of work, right? So we're like, we're going to be doing kitchens anyway. And you just say this, the renovation, we're just going to literally just plop in the new stuff and tie it in. So we added 24 units back. So we went from 106 to 130. And that wasn't even in our underwriting, right? We underwrote this thing as 106 units, not knowing what had gone on here until we actually laid eyes on it. So, fast forward 2.5 years later, we're getting offers, unsolicited offers. The market's, crazy. So it's middle of 2020, right? Right in the middle of COVID, or early COVID, we're starting to get offers. And we're like, well, why wouldn't we sell? We're getting our 5-year number, our projected 5-year sale price, in less than 2.5 years, in the middle of COVID. Let's sell. Yeah. And, of course, it was exciting for me to go full cycle in my business on my first one then. So we did, and we met we exceeded investor projections that we had originally on that deal. I've sold 2 more Texas deals, and I'm under contract to sell one in Phoenix right now. All syndicated deals that I sponsored, and each one of them is crazier than the last in terms of the prices we're getting and the offers we're getting. So, back to the market comment. I mean, I would never buy a property for the price that people are buying it from me now. I don't even know how they're making it work, but but I'm taking it. It's a bird in hand. It's money that I can't even imagine making if it wasn't just an absolute crazy market.
Yeah. Incredible. Well, and it poses the question then, as you're coaching, passive investors and active investors that are entering the market today, how do they find success in the market that we're in today? Knowing what you know and the experience that you've had in the past, and maybe your experience is a little bit skewed, right? Because you have had it so good on those past deals.
Yeah.
I mean, what kind of guidance are you giving those people as they're looking to enter the market today?
Yeah, no, for sure my experience is skewed. I mean, it's been phenomenal. All of my passive investments, which I've done probably 20, 25 of them, they've all turned out well. The worst one was a projected 18% return, and it ended up being like 13%. And a lot of things went sideways on that deal to get it to 13%. And they were so apologetic, and I'm like, well, if this is a really bad deal in this space, okay.
Right.
I'm sure there could be worse. But in any event, with the crazy market, the whole idea right now is, you have to look at trying to find properties that are off market. If it goes to a broker, brokers are going to bid it up. There's going to be hundreds of people looking at it, and there's always somebody who's willing to pay way too much. That's what it seems like right now. There are people that are finding deals through brokers that are working out apparently. I haven't dug too much into their underwriting on those as far as passive investments with them, but it seems like there may be some decent deals out there. So for on the passive side, again, if I was to dig into one of those, I would be asking a lot of questions about how do you underwrite? How do you know you're going to get that rent? What rent projections are you looking at? Are you assuming Phoenix, Arizona is still going to grow at 8% every year in rents? Or are you assuming it's 2.5%, 3%, whatever, and the rest is just gravy? And how, what price are you planning on selling it at, and cap rates and all that kind of thing, which we won't get into now.
Yeah.
So that's on the passive side. On the more active, people who want to be sponsors or currently sponsoring, again, you have to find stuff off market. Your underwriting has to be spot on and very conservative because there's just too much that can happen right now. Interest rates go up, cap rates will go up. You're going to sell it a lot less than you thought you were. So your projections can look fantastic, but then people they think everything's good for 2 years while you cash flow. And then next thing you know, you're trying to sell it or even 5 years later, and you could be in for some hurt.
Yeah, absolutely. So are you a buyer today?
I am, but it's been very opportunistic. So I haven't, the last time I went under contract for a deal was middle of 2020, and we closed that in October. That was 101 units in Atlanta, and it was off market. Literally 100% off market. Phenomenal deal. We got $1 million discount on the price. So the price we paid versus what we got for an appraisal when the bank did their bank appraisal, after we closed, the bank gives us the appraisal. I'm like, I knew I got a discount, but this is amazing.
Yeah. Interesting.
And that was on a, whatever, $7 million purchase. So $1 million on that. So that's a lot.
Yeah.
So that was the last time I went under contract on something that was through a broker. The last 2 deals I did, both this year, were things where I knew somebody who owned a property or who owned a group of properties, and they needed to recapitalize. They had an investor who wanted out. Another one was just holding on to the property, but it needed a large cash injection, and it was a single owner. So on both those deals, we just worked out a deal where okay, we're going to syndicate this property. You're going to keep some equity in the deal. But we're bringing in investors. We're going to put a new loan on it because we can get way better loans than you have on it today.
Right.
And everyone's going to win, right? You're going to end up making more money than you would have if you didn't do this. I'm going to have a great deal to bring to my investors. The investors are going to make, whatever our projections are. I'm trying to be careful not to say too much because of the SEC rules, but everyone's going to make money. Everyone's going to be happy. Right.
Yeah.
Assuming our plan goes well.
And on those type of deals where you're structuring sort of a unique deal where you're not buying out the owner, what size assets are those, generally speaking?
So one of them was, and this is, I do sway away from multifamily on occasion, although my core business is multifamily, but I still have a little bit of that fix and flip or renovation kind of stuff. So the first one was developer owned 4 triplexes and was looking to convert them to condos, and has been thinking about this for a long time and just sitting on the properties. So the properties are sitting there decaying in South Boston, which is a phenomenal place for investment right now. And the condo market there is super hot. So we're like, let's convert these things right now. Like, what are you waiting for? I'll bring the cash, right? I'll recap you, and we'll bring investors in. We'll get the developer or the contractors in here, do all the work. We're going to convert them to condos with beautiful finishes, beautiful renovations, and sell them off. So it's like a 2.5-year deal.
Gotcha.
On the multifamily side, we've got one. It's just about kind of done in terms of structuring the deal right now. I haven't gone to market with it yet, but it's 60 something units in the middle of Atlanta in a pretty wealthy area, and the price per unit is really high because it's a very nice property. But even at that valuation, we're being valued right now at 50% occupancy. Because it's like halfway through a renovation, a conversion from office to multifamily.
Oh, interesting. So
the valuation that we're going to get once it's 95% occupied is going to be through the roof in comparison to what we're getting valued at now. So even that one, like 2-3 years, and then we're able to probably get everyone's money out.
Interesting. Wow. Well, I wish we had more time to dive into some of the details on that deal because it sounds interesting, but I want to be respectful of your time and start winding down here. I've got 3 final questions I want to ask you. The first is, what's the biggest win that you've had on your apartment investing journey so far?
The biggest win, I would say, not in terms of numbers, but it's more mindset. When my friend introduced me to syndication and I took that leap, it was very hard for me actually, because I am handy. I was self-managing. I'm type A. I want to control everything. I was a project manager and then I managed finances in the W-2 world. So, which is all about control. So for me to actually write somebody else a check to go and invest it for me in an area that I knew was super difficult. But that's definitely the biggest win because that changed everything. It changed my mindset around investing. I was able to live a better life because I wasn't managing all these properties myself. So it was all passive. And that eventually led me to start my business.
Love it. What's the biggest mistake you've made on your apartment investing journey so far that we could all learn from?
Probably the same as a lot of other people say, not taking action soon enough. I learned so much. I was ready to go. And I let one conversation kind of, validate the doubt, the self-doubt that I had at that time.
Yeah. That's a big one. Okay. The last question I've got for you, and I'm actually going to mix it up a little bit. Knowing what you know now, what would you tell yourself? What advice would you give yourself, the Steve that's starting back in, 2012, 2013, 14 in that range? What advice would you give yourself?
It goes right along with that mistake, right? It's get yourself educated, but at some point you have to take action and don't let anyone else sway you from the possibilities. And it's hard when you don't know the business, you don't know this area, you've never invested in real estate. There's as many people telling you that it's a crazy thing to do and that it doesn't work out well and that people are crooked and they're going to run away with your money. You hear as much of that as you do people telling you it's wonderful and it works out well. I even had somebody who owned properties. Their parents passed away, but they inherited a ton of rental properties, and the financial advisor just said, "Sell it all. You don't want to deal with that. That's it's terrible." They tried to deal with it for a little bit, but they had no idea. They weren't educated in this space. They had no idea what they were doing. So of course it went poorly. So they end up selling everything off, putting it in the stock market. It worked out well for them because that's what they needed. But I'm listening to people like that instead of listening to myself and my peers who had already done some real estate.
Yeah.
So get educated, pick a path, and start taking action. Worst case, you don't like that path, then pick another path, right? Go passive or go active or whatever.
Yeah.
And especially now, there's so many podcasts and so many people willing to share their experience and tell you the details of what they've done. I've shared a bunch today, and I'm happy to share with anybody more of that. So
yeah,
there's lots of people like me out there.
Well, that's great advice for anybody that's listening. Steve, you've been gracious with your time. I appreciate you talking to us about your personal journey, going from, working in the W-2 space and having some limiting beliefs to eventually taking the step to buy your first duplex and then realizing, man, this isn't as bad as I thought, building up a pretty substantial small multifamily portfolio and then being introduced to syndication and really just exploding your business over the last, 5 years or so. Appreciate you taking the time to share with us. What's the best way for our listeners to connect with you, learn more about, what you have going on from a coaching perspective, mentorship perspective, as well as potentially partnering with you or investing with you on future deals?
Probably the easiest thing is to go to the website. So the name of the company, Velocity Capital, but the website is velocitycap.com.
Okay, awesome. We'll have that in the show notes. So anybody that's listening, resonating with Steve's story, go down, click on that link, and connect with Steve and his team. Steve, again, thank you for your time. Thanks for sharing your journey with us, and I look forward to connecting with you again soon.
Yeah, it was my pleasure. Thanks, David.